Welcome to CrushTheStreet.com's Weekly Market Wrap-Up. Let's start this post-Valentine's Day edition in the equities sector, which has been getting a lot of love from the mainstream media, and why not? Americans have not had a lot to celebrate about since the bursting of the housing bubble, so a little excursion from the doom and gloom shouldn't hurt. But the problem is, it will. According to a recent article from CNBC entitled "Dying Dollar: Why U.S. Currency is in Danger," experts cite the declining rate of the greenback as a percentage of the total world money supply as one metric that could be signaling the end of the dollar being the international reserve currency. If this privileged status is lost, it is argued that the United States will be forced to pay back its debt instead of monetizing it through endless quantitative easing. However, one could also make the statement that the US may be forced to rein in its trillion-dollar budget deficit anyways if other nations sidestep the greenback in favor of other currencies or gold. At present, nobody wants to openly and absolutely reject the dollar, just as Saddam Hussein, who learned the hard way. But at some point, not even SEAL Team 6 will be able to impose the hegemony forever. Moving over from sinking currencies, we can now focus our discussion on sinking companies. The famous, or should I say infamous, Carnival Cruise Line is literally neck deep in water. According to news reports, a fire damaged the propulsion system on board the unfortunately named Triumph, and the tow line used by 3 tugboats to pull the cruise liner to shore broke, leaving the thousands of sick and hungry patrons in further discomfort. It's horror stories like this that will immediately drive up the airline industry, but in all fairness, the cruise line is a healthy business. Almost everyone that I know has been on a cruise at one point in their lives, and all rave about the relative low cost for their vacations. Therefore, this recent hiccup may be the perfect trading or investment opportunity for CCL. Morally, no one died in this accident. Fundamentally, there's something either romantic or alluring about vacationing at sea, so this is a business that will be around for the long haul, recessions be damned. And finally, let's take a look at the technicals. Currently, CCL is trading at 37.35, which is where the 61.8% Fibonacci retracement level resides when applied from 2011's high point. Given that 3,142 passengers will be filing some sort of class action lawsuit, the stock has some more to fall before it finds a bottom. A more ideal price point to initiate a long position is at $33, where the 38% Fibonacci retracement lies. From there, the risk-reward ratio is more favorable to the bulls, as a logical upside will be $45 and the downside being around $28. Also, Barron's is reporting bearish options activity related to Carnival, which is another way of saying that the derivatives market will likely drive CCL much lower. Therefore, if you do want to make this trade on the long side, it is better to wait and to be patient. Finally, we'll take a quick look at silver. The market has been ugly, with the price action continuing to be capped at lower and lower valuations. Also, since the beginning of the year, the percentage of commercial shorts have been steadily increasing, suggesting that people that know more than us are placing bearish bets. Personally, I'm disappointed in the price action, but I'm also cognizant of history. Whenever people got too bearish and thought this is it, the price has shot up the other way. And that will do it for this edition. Thanks for watching, and we'll see you next week.
For more unconventional ideas, please visit CrushTheStreet.com.